Hello value investors, thank you for joining me. Today I want to talk about investment philosophy. What's the right investment philosophy? If you're new to the channel, please subscribe now so you can get my next video installment. Also, if you're interested in the stocks that I own, come over to my marketplace on Seeking Alpha, find out which stocks I own and why. I give balanced arguments for the stocks that I own, and that can help you on your way. So let's get started. Having the right investment philosophy matters so much, particularly right now in 2020. The reason being that the market has a large disconnect between certain types of the economy, whether the business's position is a low-touch economy business or a SaaS business or digital-facing business or aiding companies on their digital transformations. You get valued on one side, and if you are a different type of economy, different type of business, a different type of, let's call it, old economy business, where you have some kind of consumer interaction, you get in a different multiple. Investors are not even willing to touch that type of investment. So there's a large discrepancy. When it comes to investment philosophy, I think it's very important to going back to investors that have been there and done that. A huge mentor for me is Walter Schloss, and at times like this I was just revisiting his work, and a lot of the stuff that Walter was doing is not 100% applicable in terms of the metrics that he was looking at, like price to book, but the philosophy matters so much, and it's going to be evergreen. So you have two types of style that I think can work, and one type of style that does not work. So I'm a value investor, and I prefer to go into something where I can see that the business is not growing a lot, it's really just ticking along, but it's highly profitable, has very nice margins, and you're not paying a lot. It will have problems, but I will be willing to take that on board. The other type of style that also works, which I sometimes do, I don't do that often, but I sometimes do, is you have a business that is what I call hypergrowth. Hypergrowth is something that is unstable in terms of it's growing so far beyond 40% year over year that it has like a very large runway ahead. You're paying a large premium for that type of business, but the idea is that the premium that you're paying can be offset by the growth of the company. Those are very few and far between. That's the type of business that many people are after. So it's difficult to do, but that can work. The investment style that does not work is what I call the going nowhere fast in between. So it is kind of like high quality, ticking along business, and you're paying a large premium. These are typically mid-cap to large-cap businesses that are kind of just ticking along. Some investors call this like growth at a reasonable multiple. Now, those multiples are anything but reasonable right now. And so you have these businesses that they're not really doing very well. Now, what is very, very important is whether you are a high growth investor or a value investor, what is very, very important is that you understand very well your philosophy and you stick to it. Because when hard times come around, as they are doing right now in 2020, if you're kind of like in that middle pile, it's kind of like a reasonable business but I'm paying a large multiple, that's going to be very, very difficult to control when you see the market just become very visceral and it's down 10% at the end of the week and it's down another 5% at the end of next week. It's kind of like you've already taken a 15% hit and you're like, whoa, like the business hasn't really changed that much, but people's perception of that business has changed. So that's what's really difficult about that middle ground, that going nowhere fast. What I do think works well, in my opinion, I'm biased, is value investing, because value investing, it's been a business that's been around for a while. These are mature businesses, they generate a lot of free cash flow, and they have been through a certain number of cycles. they most likely would have been through the financial crisis and come out of it with lessons learned. So these older, more mature businesses often have been very efficiently run. They're just fallen out of favor right now, but you kind of are able to pick up these businesses very often with, let's say, a 15% free cash flow yield. So that's simply the free cash flow divided by the price. So if you get something that is trading, let's say, on a PE of 10, that's 10% earnings yield. In my opinion, that is nowhere near what the free cash flow yield, because free cash flow is the amount of cash you can take out of the business. I've got a video about free cash flow, and I think that having the right philosophy is very helpful. Now, conversely, when you have that type of businesses, very often now SaaS businesses, investors have kind of lost their mind slightly. They're willing to pay 20-25 times sales for an unprofitable business that has absolutely no path to profitability, like real life, not like non-GAAP. I mean real life, lacking profitability, and people are paying 20 times sales. And even if you say to yourself, okay, the stock-based compensation will at some point come down as the economies still grow higher, as the revenue takes off, hopefully the stock-based compensation kind of stays just trickling up over time, so you kind of get large operating leverage. But if you're paying 20 times sales and you say that this SaaS business hypothetically could have, let's say, an 8% operating margin or 10% margin, and you look at the multiples, if someone's paying 200 times operating income before interest, before taxes, it kind of doesn't leave a lot of wiggle room. Even if you look at 2020 in a period of high inflation with the asset prices just going crazy high, it's going to be quite difficult for a reasonable investor to come into that position and have any more upside. So if the game for the new investor is come in and hope that someone else will bid them out higher, that's a challenging game. So you as the investor, if you're not willing to buy those businesses that are trading at 25 times sales, don't expect someone else to come in and buy that business 25 times sales. So it's very important to understand what type of investor you are. So I'm a value investor, so I would prefer to look at a business that has a balance sheet that's very strong, has a lot of wiggle room. When I say a strong balance sheet, it does not necessarily mean debt-free. It can have some debt. It can be even leveraged 2 times or 3 times in some cases. That's really the top end of where you want to be, but it could be that it has some debt on it. But if it's making a substantial amount of free cash flow, so the EBITDA is not just a hypothetical EBITDA, it's a real EBITDA that gets converted to free cash flow, and you have an EBITDA to net debt of about 2.2, 2.5, that can be quite a strong balance sheet if the business is quite stable. And if you're not paying a large amount for it, you can sit around and wait for investor sentiment to turn back into that business. So, for example, there's this idea that if you look at brick and mortar at the moment, brick and mortar has been mostly just demolished. So you have 2 problems there. You obviously have COVID problem and you have Amazon problem. But within that, not all of them are just going to be obliterated. There are certain businesses that you kind of still need to go and touch, like furniture, for example. However, interestingly, I don't have any position in Wayfair, but if you look at Wayfair, their revenue growth rates are kind of slowing down, and in the best case, the operating margins are kind of like middle of the road, and that's before your stock-based compensation, before like SG&A, before marketing expenses, before anything. Like, you're looking at a gross margin of approximately 24-25, maybe going out at some point in the future to 25.5, doesn't leave a lot to the bottom line. Obviously, in the case of Wayfair, I don't have any position in Wayfair, but in the case of Wayfair, it's unprofitable now. I'm just talking about what the spin is that they're telling their shareholders. But you have to consider, like, if you're gonna pay 1.5, 2 times sales for something like Wayfair, which it's gonna struggle to be profitable, it doesn't leave a lot. That's the kind of what I call that kind of middle of the road, because you're kind of paying like a large multiple in that event. It's kind of like the revenue growth rate is coming down. On the other side, there are some businesses that are SaaS businesses that, in my opinion, are not like in a silly valuation. I don't have any position in Adobe, but I can make the argument that Adobe is a compelling business. It's not crazily valued. Their consumer base, whether it's in analytics or in creativity, it kind of locked in. It's kind of like an industry standard you have to get. So that is an attractive business, and you're not paying a lot. So that's kind of like, that could be a reasonable investment to make. Now, what is very, very important when it comes to investing is that you keep refining and reflecting. Just keep going, refining and reflecting your strategy. So understand what you want to do at the outset. Do all the work before you make the investment. And once you've made that investment, have the patience to wait 2 or 3 years. Because if you're just making an investment to kind of go through the next earning period, it's very difficult. It's very volatile at the moment. Sentiment goes one way or another. So I believe that what you should do is you should decide, okay, this is a strategy I'm going to try for the next 5 years, and commit to it and be patient with the results. You need to say, okay, I want to be in a high growth, and I just want to pick out the businesses that have close to a monopoly, where I can see that their revenue growth rates are north of 50%, and it's not in the crazy valuation point yet. That's what's very important when it comes to investing. Understanding your investment strategy, being patient, and reflecting a lot. I hope you found this video useful. I would like you to come over to my marketplace, check it out on Seeking Alpha, Deep Value Returns. Also, please subscribe. I'll see you soon.